Have you heard about Ronald Read, a janitor who had $8 million when he died back in 2014, and he didn't win a lottery or inherit any money. He just kept living below his means and consistently investing his earnings and ended up with $8 million bucks. We all come from different times and places with families earning different amount and having different beliefs. And these all impact how we deal with money. Take investing in a stock market as an example. People born in 1970s saw a stock market grow a lot in their teens and 20s. And so therefore, they have a more positive outlook on a stock market and are really more interested in investing. On the other hand, people born in 1950s, they saw a stock market going nowhere when they were young. So they have a negative view on a stock market and of course, less interested in investing. Hassel says people sometimes do strange things with money, but no one is really crazy. We all see the world on our own way, so there is no right way to handle money. We all make money decisions based on our own experiences, our own lives, and how we see the world. Warren Buffett is definitely one of the best investors ever, with a net worth of around $130 billion. But what is really fascinating is that almost all of his money, around 99% of it, was earned after he turned 55. So Warren Buffett didn't become rich by just being a good investor. He became rich by literally being an investor since he was a kid. He seriously started investing at the age of 10 and was worth $1 million by the time he was 30. Let's imagine a different scenario where Warren Buffett behaved more like most of us in his 20s and started investing with a net worth of $35,000 at the age of 30 and retired at 60 years old, but still making the amazing average annual return of 22%. Well, in that case, he would end up with $11.9 million. Amazing amount of money, but still 99.9999% less than what he's actually worth now. Optimism is basically the belief that odds of a good outcome are in our favor in the long run, even though there might be bumps along the way. But when it comes to things that matter to us greatly, like money, we tend to be a little bit more pessimistic. For example, a 20% dip in the stock market is definitely more noticeable to a lot of people than a 200% gain over 5 years. And that is right there the answer to our pessimism, because good things take time and don't magically happen overnight. That is also true in general terms. So for example, over the past 50 or 60 years, the progress in the field of medicine has allowed us to save over 500,000 American lives per year. But a plane crash that kills 200 people or a flood that kills 1,000 people are more noticeable to us than a 50 or 60 years of work that allowed us to save 500,000 American lives per year, simply because this is a slow progress. So look ahead, take longer time horizon, and don't let pessimism cloud your judgment. In 1968, out of around 300 million high school age people worldwide, only 300 students attended Lakeside, a small school in Seattle. And Lakeside just happened to be the only school in the world that had a professor who could get a computer, and no ordinary one, the Teletype Model 30. It was quite an advanced computer for the time, the type that even graduates didn't have access to. And for one lucky student, that changed everything. And of course, that lucky student was Bill Gates. There was roughly 1 in a million chance to be a high school student with access to computer. And of course, Bill Gates showed exceptional talent, hard work, and vision for computers. But being in Lakeside gave him a 1 in a million chance and push and a head start compared to other students. We should understand that success is quite a complex combination of factors, including both talent and luck. Hassel starts this part by saying that the key to happiness is the ability to do what you want, when you want, with who you want, for as long as you want. If we really think about it, chasing after material wealth actually does exactly the opposite. We often work harder, sacrifice control over our time and over our lives to just be able to afford more expensive things. Yet many research tell us that having control over our life is the best predictor of happiness and well-being, more than our income, the size of our house, or even our career. Chasing money without valuing time doesn't lead to lasting happiness, because simply if we cannot control our time and enjoy the result of our work, it simply doesn't matter how much money do we have. Hans Berggruen, a German who moved to America and became one of the most successful art dealers in history. He gathered a huge collection of art, including pieces by famous artists like Picasso, and in the year 2000 he sold only part of his collection for over 100 million euros. So what he did was to buy a vast quantity of art and hold on to them for a very long time. He waited for the few of those paintings to become well known and worth a lot of money. He was wrong majority of the times, but the few times that he was right made him a fortune. So it's not about being right all the time, it's to have a diversified portfolio and wait for a few winners to emerge. And those winners are called tail events. And that's the same for venture capitalists, individual investors, and entrepreneurs. You cannot be right all the time, but if you're right just a couple of times, they outweigh your losses and account for majority of your outcome. Just remember that Warren Buffett has picked over 500 stocks in his lifetime, and just over 10 account for majority of his wealth. It is so important to understand the difference between being rich and being wealthy. So being rich is about your current income and material possessions that you own, but being wealthy is about the financial assets that you have not spent. So being wealthy isn't about the flashy car someone's driving or the expensive house that they're living in. The real key to building wealth is to save your money and invest it. And actually the only way you can become wealthy is by not spending the money you do have. And I think Robert Kiyosaki explains the concept of assets and liabilities quite nicely in Rich Dad Poor Dad. The concept of nothing's free is quite simple and straightforward. For example, if you want to buy a car, you know it comes with a price tag and you're ready to pay for it to enjoy the comfort and flexibility of owning a car. But you can also steal it, but you won't be paying any money, but you'll be dealing with consequences. And those consequences are the price that you're paying. Investing also comes with a price, but it's not the stock price that you'll be paying for being in the market and owning a company, but being in the market actually brings some risks and uncertainties, and those ups and downs are the fees that you'll be paying. And of course, the higher those fees, the higher those returns at the end. Imagine you own some stock during the market crash of 2020. Because of the pandemic, the uncertainty was through the roof. But if you could handle that, manage the stress, and hold on to your investments, and maybe even adding some, you could see your portfolio growing quite nicely over the next year or two. But on the other hand, if you really didn't want to handle any stress, handle any uncertainty, you would actually sell out and miss some opportunity of further gains along the way. Have you heard about the concept of hedonic adaptation? So it's like this: when we reach a goal, we often set a new one, always wanting more. It's like being on a treadmill, never reaching a destination. And of course, setting new goals is motivating and we all should do that, but we also should know when to stop. Take Bernie Madoff as an example. He had everything anyone could ever wish for. He was super wealthy, but still it wasn't enough. He ended up behind bars for crimes he committed for getting even more money. This never-ending climbing to reach never-ending goals can eventually end in lack of happiness and fulfillment. Alright, thanks for watching all the way to the end. It was a quick review of the book Psychology of Money. I hope you learned something and now you're interested to go and pick up the book actually. Please don't forget to subscribe to the channel and liking this video.